been a really successful year, so what's driven that success? Diversification is key to the group, particularly in terms of our geographic diversification. The United States is now 42% of our business. In fact, our non-UK based sales are 73% of our business. Investment is another factor. We've invested in manufacturing efficiency, streamlining our processes. We retain and attract great people. Let's not forget about investing in people. Product innovation is key to us. We've got some wonderful product. Design is clearly part of our DNA, but product innovation has really driven sales going forward too. And we acquired a business last year. We acquired a business in the States called Lang in July last year, and the first phase of their integration has really successfully taken place. We've generated and focused very much on cash. We have a mantra of it ain't profit until it's cash. And that has really strengthened the balance sheet and puts us in good stead for the future. In terms of the customer, service is key. We are our customer's partner of choice, and we have to make sure we remain so.
Sales reached a record £311 million, up 31% year on year, and that drove profits up 51% to £16.3 million on an underlying basis. Now, we benefited from an acquisition in the year and also from weak sterling, allowing our overseas earnings to be translated favourably. But even extracting those effects, underlying profits were up by over 20% year on year, and that's driven fully diluted earnings per share up by 38% to 18.2 pence. The secret to our dividends growth is all about earnings per share and our cash generation. We've talked about earnings, but cash also improved by 52% in the year to £31.5 million cash generated through operations. And we closed the year with £3 million of net cash for the first time in many, many years. That's allowed us to improve our dividend ahead of our original plans to 4.5 pence. And going forwards, the dividend will continue to improve progressively as earnings improves, and indeed we'll start to increase the ratio of payout from the current 4 times covered.
Our large-scale investment has been in manufacturing efficiency. We invested in state-of-the-art machinery in Holland, in the United States and in Wales, and in our factory in China, which is increasingly automated or semi-automated. The payback on that has been excellent. We're competing aggressively and profitably. The good news is there's more to come. Not just bells and whistles on our existing machinery, but real advancement in robotics and other exciting innovation. We've invested in people. We've got some tremendously talented people in the group, and the more successful we are, the more talent we are attracting. And finally, we've invested in our structure and how we organise ourselves, particularly in the UK in the last year, where we brought together 3 businesses under one leadership team. We're very excited about that, and we'll see payback on that in FY18. Our success isn't just down to a highly commercial aesthetic design. It's also about creating new product formats. For example, in the last year, we launched in the United States a bag which includes a tissue within the bag which shrouds a gift. It's a great new, easy-to-use product, and that's going down a storm in the US, and we'll sell that across the world now next year. Our ability to design and innovate has created new areas of opportunity for us, where we are manufacturing in the UK bags which are not for resale. They are to be given to consumers by fashion and beauty retailers. Our design and innovation has been recognised this year, both in terms of industry awards and branding awards as well. The standout performance was in the United States. Overall sales growth of 53% and profit growth of 37%, an outstanding performance. Clearly there was some benefit from the acquisition of Lang, but overwhelmingly this is an organic growth story. and more to come. In Europe, our sales grew by 13%, but profits by 25%. We've grown our business in Poland, in Slovakia, and also seen the benefit of the capital investment that we spoke about earlier. In the UK, we invested to reorganise our businesses, and whilst the top line grew by 4%, the bottom line actually went slightly backwards by 6%. But we will see the benefit of the restructure in the UK next year. In Australia, we were absolutely thrilled to win a major new contract for the supply of greeting cards to Australia's largest discounter. Whilst that impacted on our bottom line on Australia modestly, where profits went down by 2% in FY17, we will see a very healthy uplift in Australia in FY18 as a result of investing in that contract. Building on last year's momentum, we have a record level of orders which have already been confirmed for the year. We're delighted with that. There are many incremental aspects to the business this year, so let me summarise those. First of all, the acquisition of Lang. This year we'll see the first full year of synergy benefits that we identified before we bought Lang, and I'm very pleased to say that what we felt would be the case is absolutely manifesting itself in tangible benefits. Within the Australian business, having won a very significant contract in Australia, not only is that contract in itself a standalone profitable piece of business, but it's also given us economies of scale that we can exploit for our existing business in Australia. Having invested to reorganise our businesses in the UK, we are already beginning to see the benefits of that, and we feel that the UK will grow in FY18. And finally, we are introducing into the UK a new channel of business which are not for sale consumables that we will be manufacturing in Wales. Our customer base in FY16 was 5,500 customers, and our products were present in 150,000 stores worldwide. In FY17, the 5,500 customers became 10,000 customers, and 150,000 stores became 200,000 stores. We've got a tremendous platform to build on now. So not only is our organic growth underpinned by that tremendous and very long-standing customer base, but our customers are also consolidating their sourcing to those suppliers that they know are strong in terms of being dependable and being creative, and that's really playing to our strengths. We're going to continue to invest in our business, and that will drive our margins. But organic growth is not the only way for us to move the business forward. We are looking seriously and in a very proactive basis at M&A opportunities. We're going to be very discerning. We will be very much bearing in mind how we wish to expand by brand, by related product category, and into new channels as well. And by continuing to convert profit into cash, not only can we continue to invest in our business, but we will also continue to increase dividends to shareholders.